Hello and welcome to another episode of Connecting the Dollars. My name is Emily Agosto. I'm a CPA and financial advisor with Propel Financial Advisors.
And I am Amanda Vaught, an attorney and financial advisor with Emily.
So today we are going to talk about the bond market, and Amanda's going to introduce a little bit why we decided to talk about this topic today, and yeah, how we're gonna go about it.
Okay, so there's a very popular podcast out there that's called The Compound and Friends, and so they do have good content, right? So I don't want to be negative about them, but they recently had an episode called Real Men Don't Panic Over Bonds. And so then I saw that title and I was like, what does this have to do with real men?" So I ended up listening to the episode, and that's not something that they directly mentioned. The actual content of the episode was actually really good and informative and interesting. I just think they presented it that way, for marketing purposes. But at the end of the day, what's happening in the bond market has nothing to do with real men. It's something that impacts all of us. Uh,
Yeah.
so we just wanted to address it and in our way.
Yeah, so let's start off with just a little bit of a background. I really like this quote you found from Catherine Kaminsky. She's a chief strategist and portfolio manager at Alpha Simplex Group. And she said bonds are beginning to signal that something is not okay in paradise. So they're kind of like the first, like when the bond market really starts to change, it's like, hey, we should pay attention.
Yeah, the
And
bond market is typically can be more signal
right.
than noise, right? Like in the stock market can be very noisy and hard to tell exactly what's going on. But
Right. The bond market's typically less volatile, so when things start to move, as we've seen in the past few months, it's like, what's really going on here? Why should we pay attention? And
mhm.
um, and that kind of brings us into like, what should we be paying attention to in terms of the actual numbers we're seeing from the Fed? Like, what do you think is important?
Yeah, so I think this has been kind of happening over the past several months, but one thing that triggered it recently was, well, first we had the Moody's downgrade of the United States debt. They joined S&P and Fitch, the other ratings agencies who had previously downgraded US debt. So that wasn't too big of a deal because US debt is US debt. It's going to have the rating it has. But then a week after that, the Treasury auction for the 20-year Treasury note didn't go so well. People called it tepid, lackluster, however you want to describe it. But the result was that the rate on the 20-year went up after this auction. So, rates go up as prices go down on bonds, right? They act inversely to each other, and the price is going down because there was not a lot of demand for this 20-year note. Um, so then that happened, and then the stock market reacted that same day and went down. It was a negative reaction, right? Didn't like to see this. And so this prompted a lot of talk and podcast episodes about what was going on. So um,
Sorry for the
yeah,
background noise. My cats are active right now.
yeah.
But getting back to you're talking about demand, I mean, we're seeing now that there is a higher demand for treasuries, and they may be, I don't know if it's quite 20%. I don't have that number, but, or sorry, 20 year, but the 5 to 10
Mhm.
year, because of what the market's been doing, the stock market's been doing, we've been seeing more demand for the 5 to 10 year, if that's
Hmm. Yeah.
right to say.
I
So,
believe Kathy Jones at Charles Schwab pointed this out that
yes.
the 20-year is not typically as in demand as other denominations of US Treasury. I mean, the big one is the 2-year, the 10-year, the 30-year. The 20-year is sort of an off one. So demand for that tends to be more soft than the others anyway.
Mhm.
So that's one thing to keep in mind. Another thing she pointed out was that rates are rising. This is not unique to the United States. This is happening globally,
Right.
especially in Japan is one she specifically brought up. So it's not necessarily let's keep it in context, I think is the point she's trying to make.
Right. Makes sense. Okay. So let's move on to, okay, so Isabella Walker, sorry, Isabella Weber.
Oh yeah.
She is an economist, and she brought up some good points about inflation. Let's see. So
Yeah. So
post-COVID
that
inflation
yeah.
driven by companies. So this kind of goes along with the supply and demand. So it was not driven by supply chain.
Yeah. Yeah. So she was an economist after COVID, who pointed out that companies were driving the inflation, priceflation, not just the supply shock from the COVID shutdowns. And initially she was criticized, but then later, a lot of evidence came out that a lot of companies were actually doing this, and that was one of the drivers behind inflation. Um, and inflation comes up with the bond market, because bond investors want to make more than inflation,
Right.
um, on their bonds. So if inflation is running at 4% and bonds are only paying 3%, you're essentially losing money to inflation, right? So if people are nervous or about inflation or think inflation is going to go up, that can help to serve, to drive the bond rates higher, right? Because people want to be fairly compensated for holding these debt instruments. Um, so I just wanted to bring her up because inflation now is a little bit different than post-COVID, right? We're in a different environment. Rates are already relatively high at the Fed. Um, but if we see inflation go up due to tariffs or other policy moves by the Trump administration, you know, that's going to make it tough for the Fed to lower rates.
Right.
And what investors don't want to see is in general, is the Fed raise rates even more. Um, so the signal from the bond market is, I think that's partially what unsettled investors and why we saw it in the stock market.
Right. Yeah. So bringing it back to you today, as you were kind of moving that way, the current tax bill that is on the table is potentially concerning for well, just in general for the economy, but there is in the bond market, especially since, I mean, any bill, there's going to be spending involved in issuing debt, but the sheer amount of debt that's potentially going to be issued by this bill,
Mhm.
it's a lot, and that could help
Yeah.
ease some of the demand of these treasuries, but also it can have a negative effect by like why is the perception of why is the government spending more money than they have. So kind of how do you balance those two things?
Yeah, I think when that first draft of the bill came out, it did spook bond investors saying, okay, is the United States going to never address this debt issue? A lot of projections were that it was going to increase the national debt significantly. Um, and then the other thing that, going back to Kathy Jones, who I mentioned before, Charles Schwab said, is that the United States has picked some fights with some of its biggest creditors.
Right.
So, they do have, China or Canada coming in buying these bonds. And then if the United States is, in different disputes with them, economic disputes, that's not going to encourage them to be buying United States debt. So that's going to impact it, as well.
Gotcha.
So there's so many
Yeah.
factors going into this, right? It's geopolitics, it's domestic policy, tariff policy, um, just the economy in general. All of these things coming in shows up in the bond market. So
Right.
there's a lot of different layers to it, I
Yeah,
guess my
it's a little more interesting than just like here's this bond you hold for however many years and then you get this interest. Like this whole fixed income is boring is the thing that we hear a lot, but
yeah,
right
yeah.
now it's kind of very interesting and very important to be aware of
Right.
as an
So all of
investor.
this from like one bond auction, right?
Right.
Um, and so, and and then they said in that, like I mentioned before, that podcast title, we don't panic, and we don't think this is agree this is not something to panic about, but it's
Hmm.
something to recognize that's happening, and there's a lot of factors going into it. Um, I have personally, I've seen some people start to panic a little bit.
Hmm.
We've seen prices of gold go up, crypto
Yeah.
world, that's going up. Partially that's the value of the dollar going down. So
Yeah.
that's partially a response to that. But there is a lot of uncertainty out there and fear, and people are reacting to it. And you can see it in kind of the more speculative areas of the market.
Yeah. So before we wrap up, we just want to encourage people to sign up for our mailing list, our newsletter. You can do that on our website, and we'll have it linked in all of our show notes. Um, Please follow
Yeah.
us on
I
YouTube, Instagram, etc.
Yeah. Yeah. Um, I did just want to make one more point before
Yes,
we
please.
wrapped up.
Hmm.
I did want to just say, I wanted to quote another woman named Sonal Desai. She's the head of fixed income at Franklin Templeton. Her quote was that treasuries are risk assets now. Um,
Good point. Yes.
Because I think this gets into, what does all this mean for regular people? What do we do? How do
Yeah.
I just watch it? Because at the end of the day, a lot of the stuff is out of our control, right? What's happening in the economy or geopolitics, right?
Yes.
But we all have not we all, but a lot. We have investment accounts, right? With a mix of stocks and bonds
Hmm.
can be a significant part of your investment portfolio. Um, and so you know, treasuries are getting riskier, right? Based
Hmm.
on all these different factors. So I mean, what do you do? So it depends, right? Like we can't give
Like
investment
everything.
advice, but
Right.
there are lots of different types of bonds out there. It's not just treasury bonds. There's municipal bonds, which are state and local government. There's corporate bonds. There's, mortgage-backed security bonds, all different types of credit instruments that can diversify your portfolio with. So, um, just wanted to mention that before we wrap up.
Yeah. No, that's a
Yeah.
great point to end
Yeah.
on there.
And then we did go out of our way to only quote women on the bond market in this episode. There obviously are a lot of smart men out there who can talk about the bond market, but we just wanted to highlight them today.
Yeah. Yeah. Highlighting that it's for everyone,
Yeah.
not just one or the other. So, kind of a sum up here, like you were saying, like you had said earlier, the bond market, it's more of a signal than noise. So, do pay attention when the bond market is starting to do something that, or just move more or change a little bit that we don't typically see there. And yeah, it's a interesting thing to dive into. There's a whole lot out there right now, all kinds of different podcasts and news sources about the bond market. So if you've ever wanted to learn more about it, now's an interesting time because there's a lot connected to it. And we didn't even go into this, but the Fed rates, how Amanda had mentioned that, we don't want or what were you saying, that we don't expect the rates to go up, or that the Fed has signaled that they won't go up. I'm sorry, I'm
Yeah, I think
misquoting what you said.
yeah, I think right now the consensus view is that the Fed is still going to cut rates this year,
Right.
up to two times.
Hmm. Yeah.
If we see inflation go up, if we see the bond market reacting like this is going to make it more likely that the Fed might not cut rates or that they even might raise rates.
Gotcha.
We so
Okay.
we just want to keep an eye on it. I
Yeah.
think that's going to impact the market. It's also having an impact on the housing market, right? Because
Exactly. That's what I wanted to bring up.
Yeah,
But
it's
I
going
just
to
didn't
impact
want
the
to.
mortgage rates. Yeah.
Exactly. Mortgage rates, the rates you would pay to get a loan. So it's not just the bond markets that we're talking about. It's like real life things, even if you're not invested in the bond market, that these things do come into play. So
Yeah.
I think we covered a lot of ground today. I find it very interesting. I'm not a big bond researcher, but I always appreciate when Amanda wants to deep dive into this because I always learn so much. So, as I said, please follow us on YouTube, Instagram at Propel Financial Advisors. We're also on Facebook and
All
LinkedIn.
the things.
All the things.
Yes.
You can email us directly at info@connectingthedollars.com, and we will put all the links to anything we mentioned today down below. So, thanks for listening, and we'll talk to you soon.
See you next time.
All right, bye bye.